There are moments in history when a regional conflict threatens to become something much larger. Not simply a war between nations, but a shock that ripples through energy markets, financial systems, trade routes, and political alliances. The confrontation between Israel, the United States, and Iran carries that potential. At first glance, it appears to be another Middle Eastern conflict, another cycle of airstrikes, retaliation, and geopolitical tension. But beneath the military headlines lies something far more consequential, a structural vulnerability in the global economic system. Because the modern world runs on energy, and a significant portion of that energy flows through one narrow corridor in the Persian Gulf, the Strait of Hormuz. Roughly 20% of the world's oil supply passes through this single waterway every day. Tankers carry nearly 20 million barrels of oil daily, along with massive shipments of liquefied natural gas. If this artery is disrupted, the consequences do not stay in the Middle East. They spread across the entire global economy. Fuel prices rise, shipping slows, inflation accelerates, and fragile economies begin to crack. Welcome to the financial story, where money, power, and history intersect, and nothing is ever as simple as it appears. This is the story of how a war involving Israel, the United States, and Iran could reshape the global economy, not merely through bombs and missiles, but through oil, inflation, and the delicate structure of modern finance. To understand the potential damage, you must begin with geography. Iran sits along the northern edge of the Persian Gulf. Across the water lie some of the most important energy producers on Earth: Saudi Arabia, Kuwait, the United Arab Emirates, Qatar. Together, they form the core of global oil and gas exports. Nearly all of that energy must travel through the Strait of Hormuz before reaching international markets. The strait itself is astonishingly narrow. At its tightest point, it is roughly 33 kilometers wide. In practical terms, this means the world's energy system depends on a passage only a few shipping lanes wide, a fragile corridor connecting supply to demand. When tensions rise in the region, markets react instantly, because even the fear of disruption can send oil prices sharply upward. In recent escalations, analysts warned that a closure of the strait could push oil prices toward $110 to $130 per barrel. And energy markets are not isolated systems. Oil prices influence everything: transportation, manufacturing, agriculture, electricity. When energy costs rise rapidly, the entire structure of the global economy begins to shift. Factories pay more for fuel, farmers pay more for fertilizer, airlines pay more for jet fuel, shipping companies raise freight rates. Those costs travel through supply chains, and eventually they arrive in the price of everyday goods: food, electronics, clothing, housing. Inflation spreads quietly but relentlessly. In some scenarios, economists estimate that sustained oil prices near $100 per barrel could add roughly 0.6 to 0.7% to global inflation. That may sound small, but in fragile economic conditions, it can make the difference between stability and recession. Energy is only the first layer of risk. The second layer is global trade. The Persian Gulf sits at the center of international shipping routes. When military conflict expands in the region, insurers raise premiums on cargo vessels, shipping companies reroute fleets, ports slow operations, and supply chains become unpredictable. The modern economy is built on efficiency. Manufacturers rely on precise timing. Components arrive from different continents. Assembly lines operate with minimal inventory. Even small delays can ripple through the system. The war risk in the Gulf has already raised shipping costs and disrupted commercial routes. Insurance premiums on maritime traffic increase. Companies hesitate to send vessels into active conflict zones. Freight prices climb, and once again, costs filter down to consumers. But the economic damage does not stop there. The third layer is financial markets. Global investors respond to uncertainty quickly. When geopolitical risks rise, capital begins to move. Money leaves unstable regions and flows into perceived safe havens: government bonds, gold, reserve currencies. During periods of Middle East instability, the US dollar often strengthens, while emerging markets experience capital outflows. Stock markets become volatile. Oil companies surge, airlines fall, shipping stocks swing wildly. The entire financial system begins to reprice risk. Investors ask difficult questions. Will energy supplies remain stable? Will trade routes stay open? Will inflation force central banks to raise interest rates? Because if inflation rises again, monetary policy becomes restrictive. Higher interest rates slow economic growth. Credit becomes expensive. Housing markets weaken. Corporate investment slows. In other words, a regional war can quietly tighten financial conditions across the world. There's also a political dimension. Conflicts between major powers tend to reshape alliances. Sanctions expand, trade relationships shift, strategic blocs form. Iran has already faced decades of economic sanctions from Western nations. If war intensifies, new restrictions on banking, shipping, and energy exports could follow. Sanctions rarely remain contained. They create ripple effects. Companies withdraw from markets, energy buyers scramble for alternative suppliers, supply chains reorganize, and trade patterns evolve. The world has seen this before. The oil shocks of the 1970s transformed economic policy for decades. The Russia-Ukraine conflict reshaped European energy systems almost overnight. And now, tensions in the Persian Gulf threaten another structural shift. The damage could also extend directly to national economies. Israel, for example, faces heavy financial strain during prolonged military operations. Some estimates suggest that war costs could reach hundreds of millions of dollars per day. If conflict expands into a regional war, economic losses could become severe. Infrastructure damage, military spending, declining investment, tourism collapse, all of these pressures weigh on economic stability. Iran faces its own challenges. Years of sanctions have weakened its economy. Currency instability and inflation already strain domestic conditions. A prolonged war could deepen those problems. Industrial capacity declines, exports shrink, financial isolation grows. The United States, despite its economic scale, would not be immune either. Large overseas military operations carry enormous costs. Past conflicts in the Middle East have required trillions of dollars in long-term spending, and with national debt already exceeding tens of trillions of dollars, additional war financing places pressure on public finances. No major economy emerges from a prolonged conflict without consequences, but the most dangerous damage may come from systemic shock, because the modern world economy is deeply interconnected. Energy flows through trade networks. Trade connects financial markets. Financial markets influence political decisions. A shock in one area can cascade through the entire system. Consider a simple chain reaction. Conflict disrupts oil supply. Oil prices rise. Inflation increases. Central banks raise interest rates. Borrowing costs climb. Economic growth slows. Debt becomes harder to repay. Financial markets weaken, and suddenly a regional conflict transforms into a global economic crisis. This chain reaction has appeared many times in modern history. The oil embargo of 1973, the Iranian Revolution in 1979, the Gulf War. Each event triggered waves of economic adjustment. The difference today is scale. The global economy is far more integrated than it was 50 years ago. Supply chains stretch across continents, financial markets move at digital speed, and energy demand is enormous. Even a short disruption can produce powerful effects. Some analysts warn that the current escalation already resembles the early stages of an energy shock similar to those of the 1970s. Oil prices have surged rapidly. Shipping through key Gulf routes has slowed. Markets are watching the situation closely, because the question is not simply whether the war continues, it's how far it spreads. If fighting remains limited, the global economy may absorb the shock. Energy supplies may stabilize. Trade routes may reopen. But if the conflict expands into a prolonged regional war, the consequences could be far more serious. Multiple energy producers could become involved. Shipping lanes could remain unstable for months. Oil prices could surge dramatically, and inflation could return across many economies. History offers an uncomfortable lesson. Energy shocks rarely remain confined to the regions where they begin. They propagate outward. They influence monetary policy. They shape political decisions. They change the structure of global finance. The war between Israel, the United States, and Iran carries that potential, because beneath the military confrontation lies a deeper reality. The global economy still depends on fragile systems, energy choke points, complex supply chains, financial confidence. When those systems are disrupted, the damage spreads far beyond the battlefield. Before we continue, a quick message from our channel. If you enjoy deep historical and economic analysis like this, consider subscribing to The Financial Story. This channel explores the forces that shape the global economy: oil shocks, financial crises, currency systems, geopolitical turning points. Each episode breaks down the hidden mechanics behind major events. Because history rarely moves randomly, economic structures evolve through pressure, crisis, and adaptation. If you want to understand where the world economy might go next, you need to understand where it has already been. So subscribe to The Financial Story and join us as we explore the financial forces behind history. Now, return to the question at the center of this story. How much damage could this war cause? The answer depends on duration. Short conflicts produce temporary shocks. Markets stabilize, supply chains adjust, prices eventually settle. But prolonged conflicts transform systems. They force economies to reorganize. Energy networks diversify. Trade routes change. Political alliances shift. If the war continues long enough, the global economy will adapt. New shipping corridors will emerge. Energy production will expand elsewhere. Renewable investment may accelerate. Strategic oil reserves will be deployed. But adaptation always carries cost: inflation, volatility, economic slowdown. In some regions, recession. The damage may not appear immediately, but it accumulates quietly through higher fuel bills, higher food prices, higher interest rates, and slower growth. Every generation faces its own economic shocks: oil embargoes, financial crashes, currency crises. The confrontation between Israel, the United States, and Iran may become one of those defining events, not because of the military conflict alone, but because of how deeply energy, trade, and finance are connected in the modern world. When one part of that system breaks, the effects rarely stay contained. They ripple outwards, through markets, through governments, through everyday life. The world economy depends on stability, but history shows stability is often fragile. One narrow waterway, one geopolitical miscalculation, one prolonged conflict, and suddenly the foundations of global trade begin to shake. The real damage of war is not only measured in territory or military losses. It is measured in economic disruption, lost growth, rising prices, and the quiet erosion of financial confidence. History does not repeat word for word, but the patterns remain recognizable. Energy shocks, inflation waves, financial tightening, economic adjustment. The world has experienced these cycles before, and it may experience them again. The question is not whether the global economy can survive such shocks. It always has. The question is how painful the adjustment will be, and who will bear the cost. If this gave you a deeper perspective on global economics and geopolitics, subscribe to The Financial Story, because behind every crisis lies a financial story waiting to be understood, and history still holds the answers.